Hello everyone, welcome back to the channel. Today we are going to analyze the latest NSE Market Intelligence reports and uncover what the exchange data is revealing about institutional activity, smart money behavior, risk management actions, and potential opportunities for traders and investors. Unlike traditional chart analysis, these reports provide a behind-the-scenes look at how the market infrastructure is reacting to current conditions. We'll cover institutional activity signals, margin changes, and risk alerts, smart money movement clues, sector observations, stocks under surveillance, trading opportunities for tomorrow. Let's begin. One of the most important observations from today's NSE reports is that there are no signs of systemic stress in the market. What does this mean? When markets become unstable, the clearing corporation usually reacts by aggressively increasing margins across multiple securities. However, today's data does not indicate widespread emergency risk controls. Settlement systems are functioning normally. Exposure management remains stable. Derivative position limits remain healthy. This suggests that institutional participants are not facing liquidity stress. In simple terms, the market is cautious but not panicking. Additional margins generally indicate that NSE expects higher volatility or higher risk in these stocks. When margin requirements increase, traders need more capital to hold positions. This discourages excessive speculation. Institutional traders also become more selective when margins rise. Historically, increased margins often precede periods of elevated volatility. That doesn't necessarily mean prices will fall, but it does mean we should expect larger price swings. For option traders, this is important because implied volatility often expands during these periods. Stocks under increased margin surveillance can become attractive volatility trading candidates. A common misconception is that institutions always buy aggressively during bullish markets. In reality, smart money often focuses on risk management first. Today's report suggests a selective approach. Institutional traders appear willing to participate in liquid large cap names while avoiding excessive exposure to stocks that have attracted additional exchange scrutiny. This behavior is consistent with a professional risk-off allocation strategy, not bearish, not bullish, simply selective. The absence of broad-based restrictions suggests institutions are not abandoning the market, but they are being careful. Stocks in the BE series require compulsory delivery. Intraday trading activity becomes significantly restricted. Why is this important? Because speculative participation usually declines. Liquidity often falls. Institutional participation may reduce. Whenever stocks move into the BE series, traders should pay close attention because market structure changes dramatically. For most traders, these stocks become less attractive compared to highly liquid alternatives. High position limits generally indicate strong liquidity and deep institutional participation potential. These stocks can absorb large trades without significantly impacting price. From a smart money perspective, these are the types of securities where institutional capital can accumulate positions efficiently. When building a watch list, traders should always prioritize liquid names because institutions prefer liquidity. Financials remain relatively stable. Axis Bank and AU Bank continue to maintain strong derivative liquidity. Bandhan Bank remains under observation because of higher margin requirements. Industrial stocks such as ABB and Ashok Leyland continue to show healthy participation characteristics. The Adani Group deserves special attention. While there is no major negative signal, the increased risk controls on Adani Energy Solutions suggest that exchanges are monitoring volatility closely. This doesn't imply a directional view, it simply indicates elevated risk. So, what should traders focus on tomorrow? Three areas stand out. First, high liquidity institutional names. Second, volatility opportunities. Third, avoid low liquidity BE series stocks where market participation may deteriorate. Focus on quality liquidity instead. To summarize today's market intelligence report, the broader market remains structurally healthy. No signs of systemic stress have emerged. Institutional participants appear selective rather than aggressively bullish or bearish. The most important signals today are selective margin increases, exchange surveillance in specific stocks, stable derivatives participation, healthy clearing and settlement systems, and continued liquidity in the large cap names. The overall market message is simple: neutral market environment, selective opportunities, elevated stock-specific volatility. If you found this institutional intelligence report useful, Please like the video, subscribe to the channel, and enable notifications. In our next report, we'll combine delivery data, open interest changes, participant-wise positions, and option chain analytics to identify where smart money is actually accumulating positions before major moves occur. Thank you for watching, and I'll see you in the next market intelligence update.